Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
Very well, Andrew. How are you? How
Good,
is
good,
the
good.
beautiful city of London?
Yes, thank you. Um, and just as a timestamp, we wanted to make sure that we got at least got US payrolls um, for today. So it's December 8th, and I guess about 2:30 London time. So at 9:30 US time. So I guess let's dive right into the past week. And obviously payrolls is going to be a big part of it.
Sure. So payroll was pretty much in line with what I expected. Not just the headline number, but the unemployment number, which I thought the past increase reflected in part noise. Unemployment is derived from the household survey, which is poor quality. The last month 10 basis point increase was based on a 300,000 contraction in employment in the household survey, which was completely inconsistent with other macroeconomic data or other data on the labor market. Basically, the US economy is doing very well, and that's what this report shows. The one thing that surprised me in the report was actually wage growth, 40 basis points. I was expecting actually a downside surprise relative to the consensus of 30 basis points. And the reason is we've had this huge surge in foreign workers, and that has helped keep the labor market cooler than otherwise. Also, there is a slow transmission from the tight labor market to wages, in part due to low unionization in the US. And there is also a very interesting BIS study just published that shows that in Europe, workers have traded flexible working arrangements, so working from home, against higher pay raises. And I suspect something similar has been going on in the US. So if anything, I was surprised by the strength of the wage data, but it's a single data point, so I don't want to draw huge conclusions. But, it doesn't look good for like Waller, who a couple of weeks ago told us that, the US economy was on the way down. I don't think so. I think this data shows the US economy is humming very nicely. And so I would say this supports Powell's guidance that he cannot be confident that policy is tight enough to put inflation on a sustainable path back to 2%. I don't think it changes anything for the Fed. Next week, they are on hold, but I think it gives more weight to Powell's guidance. In any event, Powell is a boss, so he's the voice that matters more than all other voices.
Okay. But in theory, these numbers obviously can be revised too, as you were saying, like maybe the quality of the data is not that great. But overall, this narrative around the US economy is slowing and potentially accelerating in its slowing, this pushes back on that. And you've been pretty consistent in saying you don't see it. And the numbers from your understanding, what you look at does not back up that. Is that correct?
Absolutely. And Andrew, we've been there so many times. I mean, there will come a time when the US economy goes into a recession, and I will climb on my soapbox and shout at the top of my lungs, recession. But it's not happening now. That's not what the data is showing.
Right. Right. Anything else of this past week that kind of stands out to you, or?
I mean, this really was the most important data point. We also had the JOLTS, but the JOLTS is released with a a month lag.
Okay.
And it showed a stable quit rates, hiring rates. I mean, basically the labor market remains tight, and for the Fed, this is the key, because that's what drives wage growth, and wage growth is what drives services inflation, which is 3/4 of all inflation. So this really was a main event, and it confirmed, the US economy is humming along just fine.
Okay, and then to reiterate for our listeners, your take generally why maybe inflation's been a little bit softer over the last 6 months than you kind of had thought it would be is mainly because there's been such a large influx of foreign workers that has increased the supply, especially in the service sector. And even though we could say wages are fairly high there, your view is that they would have been higher if the Biden administration didn't make such an effort to open the gates for a significant number of foreign workers.
Oh, definitely. I mean, the administration has a number of distinguished economists working there. They cannot not have realized that Biden's electoral promises would lead to a demand shock. So probably what happened is they decided to create a positive supply shock to limit the impact on inflation. And so you've had this surge in foreign workers relative to end 2019, sorry, the labor force is up 3 million, and 80% of that increase is foreign workers. And you can really see the growth picking up under Biden. I mean, under Trump, there was no more growth, no more migrants let in. Under Obama, there was, normal growth, but under Biden's, the growth has outstripped all previous Democratic administration. I think you can see the impact in voters' perception that the economy is not working for them, and complaints about too many immigrants. I mean, real wages relative to end 2019 are still below those levels, both if you use PCE and CPI. And the other factor, of course, that's driven down inflation is energy prices. There, I am throwing the towel. I changed my Fed call to on hold next year from previously 2 hikes, and it's driven by these labor market changes we just discussed, but also by energy prices. One of my key views has been and remains that because we are in the high inflation regime, core inflation is very correlated with energy prices. And in the third quarter, energy prices picked up. I was very pleased with myself because my view worked. Sadly, energy prices are now down and inflation is down. And so I changed my view. I think, energy based on energy prices remaining where they are, I think we're going to have sticky inflation around 3% next year. And so the Fed won't be able to cut.
Okay. Okay. And then obviously today was important, but the markets, the equity markets are just opening, obviously fixed income market. Just the last thing on that, anything surprising how the markets reacted to any data early in the week, I guess jolts, or I guess specifically how the market is reacting to payrolls?
I mean, the market is not going to give up easily on its rate cut. So we will need a bit more evidence and a bit more jawboning from the Fed that first quarter rate cut or rate cuts are not in the works.
Right. I mean, I know you don't agree, but there is like I would say a 15 to 20% narrative, my understanding, of market participants that were in the wait, we could actually have a hard landing and we may be heading down that path. So after today's number, that kind of takes that off the the table. So yes, some cuts will come out, and that may not be great for equities, but then there's the flip side that there was the potential fat tail for a big drop off in the U.S. economy, and that looks like that's not. I know it's not a surprise for you, but that was a view of some, especially equity focused participants, and that seems like that's off the table. So it's probably not surprising that between those offsetting, equities are fairly flat and may actually do okay today.
And the macro regime we are in is basically Goldilocks, because we have strong growth. And yes, wage growth is 40 basis points, but what's 40 basis points between France? I'm joking here, but the bottom line is that growth is strong. The Fed is not aggressive. If you look at break-even, market faith in the Fed ability and willingness to stabilize inflation is as strong as ever. To me, this is a great backdrop for risk assets.
Yeah. Okay, great. And then for the upcoming week, anything to look out for? Yep.
The usual, CPI. I actually see a bit of a downside risk to the 30 bips consensus for core month-on-month. And that's because energy prices, which I monitor by looking at gas prices, are down. So there is this correlation. And so I suspect we could very well end up below 30 basis points. Then we get the retail sales, and I think the consensus of 20 basis point increase for the control group is reasonable, especially since headline inflation is likely to be close to zero for goods, or even below. So all good there. I'm going to be looking at the small business survey, because if you take the hard part of the survey, meaning when respondents are asked to comment about what has actually happened, as opposed to what they think is happening or is going to happen, it actually tracks really well with the services PMI. And so I would be looking for a confirmation of the uptrend in the services PMI that was what we saw this week. So this is one where I'll be posting on Bloomberg. Well, I am always posting on Bloomberg, but this is an important one. Then the budget deficit on Tuesday. So I think part of the pessimism around the economy could be caused by the budget, because we've had 2 consecutive months of 300 billion decrease in the deficit. And I think many people have not realized that this is just the mechanics of the student debt forgiveness and cancellation. That in the US, when the government decides to implement something super costly like student debt forgiveness, the rules say that in terms of budget impact, it has to be included in the budget upfront on a present value basis rather than on an accrual basis. So as a result, in September 2022, when the administration decided to forgive the debt, there was a 300 billion increase in the deficit. And so this September, obviously, since there was no increase, there was a 300 decline relative to last year. And the same thing worked with the forgiveness. The forgiveness was the cancellation of the forgiveness. It was implemented in August. So the deficit in August this year went down by 300 billion. So it looks like there was a big change in fiscal policy, but trust me, there isn't. This is an election year. We've just seen the most extreme Republican saying that basically they were not going to shut down the government, that they would stick to the agreement on expenditures that was struck at the time of the debt ceiling deal, for a very simple reason. The big prize is the White House and Congress. So the last thing you want to do if you are a Republican is to shut the government, which would lower your chances of winning those big prizes. So, you know, fiscal policy is not going to get consolidated this year, and it's not going to be a big source of growth, because the deficit is probably going to remain stable around 6%, excluding the impact of student debt forgiveness, but it's not going to come down either. And then you have this fantastic growth in employment, in real wages, which is recycled into consumption because the household savings rate is so low. You know, and my expectation is still the US economy to grow above trend this year. So back to the data, the rest is really PPI, import prices, or we're likely to see a small increase. In general, inflation is goods price inflation is also behaving as I expect, meaning it's decoupling from import prices and recoupling with the PPI by comparison with before the pandemic. PMI and the manufacturing data for the US, small improvement or moving sideways, which seems reasonable to me. And jobless claim, as always, you know, not much happening there, still consistent with a tight labor market. So that's a week. I think the biggest potential for surprise is a downside surprise in the CPI, which will, you know, make the Goldilocks economy even more of reality.
Mhm.
So
Okay.
good, basically. All good.
And I think Sam will be releasing his prediction analysis on CPI, right?
Yes, and we will put it on the Bloomberg chats, obviously.
Exactly, and everyone should reach out for any questions on that. So, okay, cool. Well, definitely a super interesting week. Let's hang on. I'll just highlight a few things if people didn't get a chance. Certainly on the professional side, Caroline put some interesting pieces out on South Africa. So certainly on the emerging markets front, Mir's updated the China growth tracker. Obviously, there's a lot of focus on the real estate market and also the consumer in China. Global Rates Weekly from Mustafa and the guys kind of focus or really giving their explanation on what's driving or what has been driving this rally. Obviously, some of that is being unwound today. We've released a few of our gray swans, which I know a lot of clients have thought of us over the past couple of years, especially around this time of the year. So that is, it's not a black swan. It's not like a 1 in a million chance. It's more like a 1 in 10,000 chance. The
20% for my gray swan, so I hope people will read it.
Okay, exactly. I'm sure it's gonna be good. So I think gray swan is going to be a big part. Obviously, we look into credit. John Tierney had a nice piece on credit. Time to move underweight there. Obviously, Bilal's focusing a lot on the BOJ and any potential movement away from negative interest rates there. And even if they do, what the potential impact is, and obviously a whole lot more. So recommend everyone to reach out. And for our pro clients, just a friendly reminder that we send out this summary of all the key pieces during the week on the weekend. And that will also kind of click through to those pieces if you want to look at article by article. So wish everyone the best of luck. And I think we'll do this one more time this year. But for people who won't be around and won't listen next week, happy holidays to you and your families, and happy new year. Any parting words?
Good luck for whatever is left of the year, and yes, happy holidays.
Great, thank you.